In microeconomic theory, the opportunity cost of a choice is the value of the best alternative foregone, where, given limited resources, a choice needs to be made between several mutually exclusive alternatives. Assuming the best choice is made, it is the cost incurred by not enjoying the benefit that would have been had by taking the second best available choice. The New Oxford American Dictionary defines it as the loss of potential gain from other alternatives when one alternative is chosen. As a representation of the relationship between scarcity and choice, the objective of opportunity cost is to ensure efficient use of scarce resources. It incorporates all associated costs of a decision, both explicit and implicit. Thus, opportunity costs are not restricted to monetary or financial costs. The real cost of output foregone, lost time, pleasure, or any other benefit that provides utility should also be considered an opportunity cost. Explicit costs are the direct costs of an action, business operating costs or expenses, executed through either a cash transaction or a physical transfer of resources. In other words, explicit opportunity costs are the out-of-pocket costs of a firm that are easily identifiable. This means explicit costs will always have a dollar value and involve a transfer of money, paying employees. With this said, these particular costs can easily be identified under the expenses of a firm's income statement and balance sheet to represent all the cash outflows of a firm. Examples are as follows. Scenarios are as follows. Implicit costs, also referred to as implied, imputed, or notional costs, are the opportunity costs of utilizing resources owned by the firm that could be used for other purposes. These costs are often hidden to the naked eye and aren't made known. Unlike explicit costs, implicit opportunity costs correspond to intangibles. Hence, they cannot be clearly identified, defined, or reported. This means that they are costs that have already occurred within a project without exchanging cash. This could include a small business owner not taking any salary in the beginning of their tenure as a way for the business to be more profitable. As implicit costs are the result of assets, they are also not recorded for the use of accounting purposes because they do not represent any monetary losses or gains. In terms of factors of production, implicit opportunity costs allow for depreciation of goods, materials, and equipment that ensure the operations of a company. Sunk costs, also referred to as historical costs, are costs that have been incurred already and cannot be recovered. As sunk costs have already been incurred, they remain unchanged and should not influence present or future actions or decisions regarding benefits and costs. Decision makers who recognize the insignificance of sunk costs then understand that the consequences of choices cannot influence choice itself. When a company abandons a certain component or stops processing a certain product, the sunk cost usually includes fixed costs, such as rent for equipment and wages, but it also includes variable costs due to changes in time or materials. Usually, fixed costs are more likely to constitute sunk costs. Generally speaking, the stronger the liquidity, versatility, and compatibility of the asset, the less its sunk cost will be. The discounted cash flow method has surpassed all others as the primary method of making investment decisions, and opportunity cost has surpassed all others as an essential metric of cash outflow in making investment decisions. For various reasons, the opportunity cost is critical in this form of estimation. First and foremost, the discounted rate applied in DCEF analysis is influenced by an opportunity cost, which impacts project selection and the choice of a discounting rate. Using the firm's original assets in the investment means there is no need for the enterprise to utilize funds to purchase the assets, so there is no cash outflow. However, the cost of the assets must be included in the cash outflow at the current market price. Even though the asset does not result in a cash outflow, it can be sold or leased in the market to generate income and be employed in the project's cash flow. The money earned in the market represents the opportunity cost of the asset utilized in the business venture. As a result, opportunity costs must be incorporated into project planning to avoid erroneous project evaluation. Only those costs directly relevant to the project will be considered in making the investment choice, and all other costs will be excluded from consideration. Modern accounting also incorporates the concept of opportunity cost into the determination of capital costs and capital structure of businesses, which must compute the cost of capital invested by the owner as a function of the ratio of human capital. In addition, opportunity costs are employed to determine the price for asset transfers between industries. When a nation, organization, or individual can produce a product or service at a relatively lower opportunity cost compared to its competitors, it is said to have a competitive advantage. In other words, a country has comparative advantage if it gives up less of a resource to make the same number of products as the other country that has to give up more. Absolute advantage refers to how efficiently resources are used, whereas comparative advantage refers to how little is sacrificed in terms of opportunity cost. When a country produces what it has the comparative advantage of, even if it does not have an absolute advantage and trades for those products it does not have a comparative advantage over, it maximizes its output since the opportunity cost of its production is lower than its competitors. By focusing on specializing this way, it also maximizes its level of consumption. Similar to the way people make decisions, governments frequently have to take opportunity cost into account when passing legislation. The potential cost at the government level is fairly evident when we look at, for instance, government spending on war. Let's assume that entering a war would cost the government $840 billion. They are thereby prevented from using $840 billion to fund healthcare, education, or tax cuts, or to diminish by that sum any budget deficit. In regard to this situation, the explicit costs are the wages and materials needed to fund soldiers and required equipment, whilst an implicit cost would be the time that otherwise employed personnel will be engaged in war. Thank you for watching. Don't forget to please like and subscribe. If you have a topic you would like to suggest, leave a comment.